morning, everyone. My name is Mark McLaughlin, and I'm the Chief Executive Officer of Pacific Union International. Welcome. Stop. Welcome to Real Estate Outlook 2017. I can share with you that our entire organization is beaming with excitement about today. It is probably the first time in history that we know of that a brokerage company has partnered with a forward-looking research firm, which we have done with John Burns Real Estate Consulting out of Irvine. And we couldn't be prouder to have them as a partner and give you vision to 2017 tonight. So we're very, very excited about it. We're welcoming 3 different audiences tonight. We have a live streaming broadcast here in the United States, where this presentation is live to computers all over the United States, conference rooms, things like that. We are also translating this to Mandarin and streaming it live to China. It's 8 o'clock in the morning on Thursday morning over there, and we have people tuning in for Real Estate Outlook 2017. And then to the 400 of you here, thank you for taking time out of your day and joining us. I don't think we're going to disappoint. We have a few special guests that I really want to introduce tonight. In the front row here is my good friend, Jeffrey Highland from Hilton and Highland in Beverly Hills, and he's our Christie's partner down in Southern California. Welcome, Jeff. And then one of the more famous people in our industry in the front row here is Leslie Appleton Young, the chief economist of CAR, California Association of Realtors. Welcome, Leslie. A very, very special guest is here to welcome our Mandarin-speaking audience in China, and that is Rupert Hugeworth. He is the chairman and publisher of the Huron Report. And the Huron Report, for those of you who don't know, is the rich list of China. And we began a relationship with the Huron Report and Rupert in May of last year, in May of 2013, and it's been fantastic. So Rupert, please join me on the stage to welcome our Mandarin-speaking clients.
Thank you, Mark. 那各位女士们、先生们，大家早上好。我是一个英国人，胡润。我就今天很荣幸能跟太平洋联合合作，做一个媒体战略合作伙伴呢，就能推动一下中国这些企业家的国际化了。我们今天就是在预测2017年的旧金山湾区的经济的房地产的预测了，所以我们就是预测3年以后的这个房地产市场，这是相当的重要的一个idea。我们就是一直在关心中国的企业家们的发展呢。我们发现最近这个经济还是上去了蛮多。最近我们发了一个百富榜，我们发现有358位是10亿美金以上的财富10亿美金以上的企业家的。这个跟10年前来对比的时候只有4个人，所以从4个人就变成近400个人。最近10年，这个变化的巨大了。第二，我们就看到了一个很了不起的，是最近我们就看这些中国这些企业家要越来越国际化了。我们发现今年和去年来做对比的话，那这是国际化的多。我发现有那么多的企业家现在又对那个旧金山湾区特别感兴趣，要做一个投资的目的地。那要做投资目的地成功的话，那你必须要能预测。所以今天这个活动，我们胡润百富还是挺关心，也很荣幸能跟太平洋联合合作这么一个活动的。好，我就祝你们今天能关注的很明显了，然后我也很开心在这儿了。Thank you very much. Just for those who didn't quite get all that, I was just saying that we're really proud to be a strategic media partner of Mark and Pacific Union. You know, the Chinese entrepreneurs have or the rich in China have changed enormously over the last few years. This year we just ranked 350 odd Chinese dollar billionaires. And if you compare that with just 10 years ago, there's only 4. So we've come from 10 years, in 10 years we've sort of kind of up 100 times. And what we're seeing now going forward, and that's why this sort of conference is so important, because they're now going international and they want to know how to do their investments. And this is why this sort of conference is extremely meaningful. We're very proud to be here. Thank you, Mark.
Thank you,
Thank you, all of you.
Yeah, thank you.
Thank you.
Rupert's been my host and tour guide in both Beijing and Shanghai in the last 12 months, and is just a fantastic individual for us to have as a strategic partner. Thank you, Rupert. Okay, so our agenda. We have about 45 minutes of presentation for you that I think you'll find to be very, very exciting, followed by some questions and answers that we hope you shape during the course of the presentation, and feel free to ask at the appropriate time. We're going to start with a Bay Area economic overview. We're going to drill down into 9 key markets, basically county by county here in the Bay Area, and then give some oversight into Lake Tahoe, which is one of our important markets as well. We're then going to go into some similarities that occur in all 9 of these markets, so that you get some perspective of the Bay Area as a whole in the real estate market. And then we'll go to Q&A. So we want it to be very interactive towards the end of this. We also have our own Rick Walters. For those of you that are streaming this presentation, our own digital media director, Rick Walters, is in the audience. And if you want to ask questions, go to @PacUnion, #RealEstateVision, and you can be interactive with Rick throughout the entire presentation and ask questions there through Rick if you'd like to. Okay, I can't tell you enough how proud we are as an organization to partner with John Burns Real Estate Consulting out of Irvine, California. John and his team are the only research that we can find that's forward-looking. As John said to me today, we really put our neck out there. It's such a pleasure to read his research because it's not in the rearview mirror. He's going to share with us information out to 2017. So a great big round of applause for John Burns to join me here.
Thanks, Mark. And yeah, I know I'm going to be wrong, but we try to pull together a lot of information to figure out what's going on in the market. And the one thing I can't figure out is if the Chinese are going to keep coming. So at the Q&A session, I'm going after you. So I'm serious. I'm just going to give you a heads up now.
I just hope we didn't say anything that we don't agree with.
Yeah, exactly. Don't pay attention to this idiot over here. Yeah. So we're going to start off with a little boring stuff, just some definitions. We have our own definition of how you track the price, because as you know, the median price moves up and down based on what's transacting. So there's all these complicated models that appraise all the homes in the market. We've got one, and that's what this Burns Home Value Index is. So when I talk later about price, that's what we're talking about. You've got something.
And then Pacific Union is going to share some data with you as well. Our source for that information will be the MLS that we use as a core tool in our business every single day. In 7 of the 9 markets, we're just going to be tracking single-family homes. In San Francisco and Lake Tahoe, we'll include condos. But the source of our data will be the MLS.
All right. So as Mark said, we've got a lot of data, so get ready. We are sitting in a very large market here. If California were its own country, it would be the 8th largest economy in the world. Southern California by itself would be the 16th, and Northern California by itself would be the 21st. So this is a big market, and you wonder why the biggest country in the world is considering looking at here, because it's such a big market and so accessible. So I know that we tend to look at the market city by city and county by county. I'm the guy who's going to step back a bit and just give you some of the bigger picture. So there's 5 economies here the way we look at it. One's the San Francisco economy, which includes the San Francisco, Marin, and San Mateo counties. The second would be the East Bay, which includes Alameda and Contra Costa counties. The third, which is San Jose, which is the Santa Clara County. And then, of course, Sonoma and Napa are their own counties. So when I talk about the economy, I'm grouping some counties here. So from a job center standpoint, the 3 major economies are about the same size. The orange here is population, and the black or gray is the jobs, and we went with San Francisco Giants colors here for very obvious reasons. But if you look at the gray, which is the jobs, we've got about 1.1 million jobs in San Francisco. We've got slightly less than that in the East Bay, and we've got slightly less than that in San Jose, so pretty equally sized. But if you look at the population, really the East Bay is more of a commuter market and a much larger population in the East Bay with 2.7 million people versus 1.9 in San Francisco, Marin, and San Mateo, and about the same in San Jose. Sonoma and Napa, obviously quite a bit smaller, but very important markets. But in terms of growth, so I'm going to go back to this slide. What's bigger? Population, right? What's growing is what matters to our industry, which is employment, because it's not little babies that buy houses, it's adults with incomes, and that's job growth. So if you look at the job growth and the population growth, San Francisco's growing about 0.9% per year, which is about the national average, but 3.3% job growth over the last 12 months and similar before that. That is a really strong driver of housing fundamentals. The East Bay, 2.2% job growth. San Jose, 3.2%. Sonoma and Napa, which are not known for their employment bases, they're growing fast as well, too. So if there's one good data point I could say to pay attention to, because the population data is not that great, it's really the job growth numbers, and they're solid. So if you look at the home price, one of the things, and Dean, who works with me and runs our Northern California operations, will come up in a minute. This is such a supply-constrained market, and we build so few homes for all these jobs that we're creating and all these people that are growing. In fact, I was just mentioning to somebody a minute ago who's from Houston, they built as many single-family homes in Houston last year as we did in the entire state of California. There's just not a lot of construction going on here, and when that happens, it gets pretty damn expensive. So this is what we've got, $912,000 median price in San Francisco, where only 42% of people can afford to buy that home. In the East Bay, our affordable outlet, $585,000, where 43% can afford. San Jose, $787,000, where 29% can afford. And even Sonoma and Napa, $475,000 plus or minus, where even a smaller percentage, because the incomes aren't as strong, can afford to buy. So this is a very expensive place to live. I understand if you come from some other countries, though, and you look at San Francisco compared to great cities, it's pretty dang cheap compared to Hong Kong and Shanghai and Paris and London and a lot of other places. And I think that's a different perspective that's been part of the home price appreciation we've seen. So I want to talk a little bit about the mortgage industry, because for those of you that aren't selling to all cash buyers, it's 80% plus of the revenue in a lot of cases. So it's really important. And the Wall Street Journal and others have been very misleading, not by intent, but because they're really covering what just the banks are doing, and they're really covering what the four big banks are doing. And even the Fed regulates those four banks. The non-banks are doing different things, and the non-banks have now become 23% of the mortgage market. But let me step back and talk about what government intervention can mean to our industry. So going way back to 1944, when the GI Bill came in, we'd had 45% plus or minus home ownership forever, and then the government said, you know what, we're going to make it easier, we're going to back home ownership, and grew it all the way to 60%, and it's never fallen below 60% since they made that bill. I bring that up because everyone's familiar with that, but what they're not as familiar with is what happened in 1992, where it's something that became nicknamed the GSE Act, where they essentially said, hey, we're stuck around 62%, or at the time, I guess maybe it was 64% home ownership. How can we grow it even more? Hey, Fannie Mae and Freddie Mac, we want you to start buying more aggressive mortgages from people with lower FICO scores and higher loan-to-value ratios. And we grew home ownership all the way to close to 70% by 2000, but to 68% or so by 2000, which was the most aggressive time the mortgage industry had ever been at that point, and then it got very frothy. I'm mentioning all this because the headlines have been that home ownership has plunged and it's the lowest it's been in 19 years. That is true. It's kind of back to normal levels, honestly. It's not as negative as you might think, and it's been about government intervention in the mortgage industry. And how they continue to intervene and control the mortgage market is going to make a huge difference in how many people buy homes, how much price appreciation we see. So let me bring some clarity that I've been working with the American Enterprise Institute to analyze a lot of data. And so I'm going to share some of this with you today that I think will hopefully be enlightening and a little bit different than what you hear from the pundits in the paper. So there is some tight credit out there, but there's also some loose credit. The one instance of the tight credit is that in normal times, and I'm using 1990 to 92 at the bottom here as normal before this GSE Act, about 10% of the loans went to people below a FICO score of 640. So 640 is about the bottom third of the country is below that. So think of your high school class, and it's the bottom third of your high school class. About 10% of them could get a mortgage. I'm surprised they would do that in my high school class. But Then we grew that to 25% in 2000. We're at 5% today. So there is some truth that we're even lending we're not making loans to people below 640 at a normal rate. Why? Because they're far more likely to have a problem, and the banks know if it has a problem, the government's going to put the whole thing back in my face. So that's what's going on there. This documentation issue, which I hear so much about how credit is tight, credit is tight, credit is tight, but then when you really start asking the questions, they're just saying the documentation is hell. And I want to remind you, the normal lending, the documentation was hell. There was no low doc, no doc loan. They had to dot every I, cross every T, because that's what banks do when they're making a loan. Banks are conservative. So we had only made 2% of the loans in 2000 were low doc, no doc. It went to 25% at the top of the market, and that's what got stupid, right? That never should have happened. We're back at zero right now. But I got to tell you, given what the banks just went through, that ain't changing. The documentation that you're dealing with now is the documentation you're going to be dealing with next year and the year after that, because the banks know they need to protect themselves. So that's not tight underwriting. That's just careful underwriting, in my view. Loose credit. So we used to only make DTI as a debt to income ratio, how much all your debt service, your student loans, your credit card, your mortgage, everything else, what percentage of that is of your gross income. It used to be that only 5 to 10% of mortgages would go above 42% debt to income ratio, got to 28% in 2000, went to 43%. Dodd-Frank, which got passed, said, you banks shall not make a loan above a 43% debt to income ratio, but until the housing market stabilizes, we're going to say anything purchased by Fannie and Freddie or insured by FHA is exempt. So what do we have today? 28%. 28% of all the mortgages being made today are above 42% debt to income ratio. That's not tight credit. Combined loan to value, if you get a second loan, that's why it's combined. Normally, about 26% of the world would get a mortgage above 90% and pay mortgage insurance. It grew to 35, it grew to 40. This is not true in the Bay Area as it is nationally. We're at 45 right now. So FHA and the other programs, and actually the FHFA just announced 2 weeks ago that they want Fannie and Freddie to expand their box from 95% LTV to 97, because 95 wasn't enough. The government is intervening in our business to help mortgage liquidity, to help our market be strong. So what does all this mean? They took the 2007 pool of mortgages that were made, which is the absolute worst pool of mortgages you would ever want to make, right? 2007, right before the market crashes. And they knew that Freddie Mac's portfolio, 19% of it went into default. If they had been lending under normal criteria, it would have been only 6%. If you look at today, we're at 10. So yeah, we're not as nearly as crazy as we were in 2005, but we haven't gone back to the normal 1992 and pre-92 lending, which is not really the scuttlebutt that you hear going on the industry. So anyway, this is what the data shows. So let's talk about the risks to our outlook too. So the biggest risk I see in this market, other than the Chinese stop coming, is the stock market and particularly NASDAQ. And I can't predict what's going to happen there, so I'm just assuming that's going to be fine. But we obviously have to pay a lot of close attention to that, much closer on the west side of the Bay Area than further inland. Job creation, as I showed you earlier, and that happens to be pretty darn good data, so I would pay attention to that. Mortgage rates, which the bond market is continuing to forecast to rise, and it continues to be wrong, but at some point I think they're going to be right. And then mortgage policy, which I just spent a lot of time covering, but it's more accommodative to first-time buyers than most people think. A lot of the lack of first-time buyer isn't as much about them not being able to get a mortgage as is more about them not even trying to get a mortgage, and there's a lot of reasons we can talk about related to that. And then there is a credit box, which the banks have said you have to fit in this box, and if you're not in the box, I can't make you a loan. That's going to get easier. And then the BlackRocks and the PIMCOs and the people that run your big bond funds are the ones that normally buy mortgage-backed securities. given what's happened, they're not touching mortgage-backed securities with a 10-foot pole, so the Fed's been buying them all, and we need them to come back and start buying mortgage-backed securities. And then finally, anything associated with consumer confidence, which that can encompass a lot of things. But this entire recovery, all the consumer confidence measures we look at have not even got back to average. So the consumer still is nervous about what's going on. And Mark's got some risks too.
So, John, the banks aren't going to relax the standards for documentation, but do you think they're going to relax the standards for credit and debt to income even more so than now?
Well, they'll relax them for credit. They're not going to relax them for debt to income. I don't. Well, actually, let me say it another way. They're only going to do what Fannie and Freddie will buy from them, and FHA will insure for them, and they have some confidence they're not going to get put back in their face.
So the mortgage industry has been described as getting a root canal. Do you see that going forward?
Well, they're still getting lawsuits. They're still getting a root canal. They're being told to lend aggressively, you idiot, while I sue you for all those loans you made last time around. I mean, they're talking out of both sides of their mouth.
Yeah. Okay, so speaking of consumer confidence, in the brokerage business, we deal with consumer confidence all the time in a little bit different way. We engage with homeowners or home buyers all the time, and sometimes we have to walk the path with them. Are you buying a house or are you buying a home? Are you trying to time the market, or are you focused on the time that you're going to own the home? Okay, and those are sort of subjective indicators, but it speaks back to your consumer confidence things. In our eyes, we don't see the confidence in the consumer. We see a lot of anxiety in a very frothy market. And so what do we tell consumers? Well, I'm going to give you a quote that I was visiting with Leslie Appleton Young here just before we walked in, and I attended a conference that she put on, I think it was in 2007, and somebody raised their hand and said, when's the best time to buy real estate? And Leslie's answer was 5 years ago. Okay? Now, that can be the answer, as Leslie would say, at just about any point in time. So if you're time in the market and you're buying a home for your family, it's very different than trying to time the market as an investment in real estate. Fair enough?
Definitely.
Okay. So I think from here, we're now going to drill down into 9 different market summaries. We're going to do 8 Bay Area counties, and then we're going to do the Lake Tahoe area. So now I'd like to have Dean Worley join me on the stage, and he's going to walk us through the microeconomics and the outlook to 2017 for our markets. Dean, welcome.
Thank you very much, Mark. We are going to, again, go a little more micro now. We're going to do 9 markets in about 9 minutes or so strap in and get ready, because here we go. We're going to start with Napa. Napa is kind of a tale of 2 counties. It's kind of a northern county, has a lot of the luxury, a lot of the vineyards, and is a little more middle class down to the city of Napa and down to the south. So overall, that kind of makes for a fairly kind of modestly upper middle income kind of profile county-wide. We see prices. We're going to see the bullet you see there now is going to be something you're going to see throughout every single of these micro markets we look at here. That is to say, we've had good appreciation looking backward. We expect, though, this appreciation is going to start to slow in 16, 17, and 18. Again, you're going to see that pretty consistently. Net worth drives a lot of the retirees, a lot of those upscale buyers. Investors have been a big part. That's another thing, actually, I think you'll see. You won't see that bullet on each of these counties that we do, but you will see that sentiment. That is to say, those investor buyers have been a big part of the market, a big part of the market uptick. We're starting to see those shy away a little bit, and their share of the market is starting to diminish as time goes on. Another thing, I hate to say this, but another thing you're going to see a lot of is that last bullet there, limited supply. It's maybe a little more heightened in a place like Napa, where it's very difficult to get anything entitled there. But in most of the Bay Areas, both in terms of the jurisdictions or in terms of the anti-growth neighborhood sentiment, you're going to have a really hard time getting things out the door. So you tend to have pretty limited supply.
So Dean, prices up 8% year over year. What do you see for 15 and 16?
Low single digits.
Low single digits, 3, 4, 5?
If that.
If that, okay, changing market. Okay, so we're going to show you some graphs on each one of these markets that give you some perspective as to where we came from, because Dean and John are giving us perspective on where we're going. So in the Napa market, this is a snapshot of homes sold and the volume from 2007 to 2014. The dark gray bars represent volume, or the dollar value of the homes that are sold. The orange line, back to the giants again, represent units sold. Napa Valley went into the correction that we experienced in 2006, 7, and 8 earlier than most of the other markets in the Bay Area. So their recovery, you can see here, is reflective of starting on units in 2007. And the interesting thing part of the market dynamics is the units were rising for almost 7 years, and the volume really wasn't tracking. And what that means is that the prices were falling. And I think that speaks back to the investors that are in the market that were buying some of those REO properties there. And check this out, in 2012, the units in Napa County start decreasing at a pretty accelerated pace, while the volume is still accelerating. I think that's the rearview mirror, 8%. If that continues, supply and demand dynamics, we'll have to watch that going forward for our appreciation going forward. As Dean said, Napa County is the tale of two markets. You really have a southern market and a northern market. The dividing line seems to be Yountville. Up north in St. Helena, your median home price is $1 million, whereas in Yountville, it's $815, and down in Napa, it's $539. So different dynamics in this marketplace than we'll see in a few others. Let's move on to Sonoma County.
Sonoma County, the similar kind of vineyards and a kind of an upscale feel in certain pockets of Sonoma County, but overall, it's a little bit more of a middle class. That median income, that's a household median income there of $61,000. That's not that much higher than the national norm. So it's not, we see the incomes rising, but roughly in kind with inflation. It's got a major retirement base, but it really makes for another limited new home activity kind of market. There's very little going on right now. It's tough there to get things through the planning process and fully entitled. Prices, again, up 8% year over year, low single digits. You see there looking forward, we see some fairly muted appreciation going forward. A little more qualitative point here is the SMART train, the light rail train that's going to be coming up in Sonoma. Some people are pretty excited about that. We'll see what kind of impact that has on the housing market there, because these folks tend to work both in Marin, we'll see later, and here in Sonoma. A lot of those folks work down in San Francisco, so that'll make it easier for them to live in Sonoma and work in San Francisco. We'll just see how that works, because it's a ferry and it's a train, and it's not going to be easy. So
keep in mind, in Sonoma County, we have the economic engine of Santa Rosa, and then we've got some submarkets like the Sonoma Valley or the town of Sonoma and Healdsburg to the north. So when you look at this, remember, it's the whole county. It's not the local neighborhood. The same dynamics. The Sonoma County started to recover earlier, or actually went in earlier and came out earlier than did happen in the same way it did in Napa. So you see that the units tracked at a more aggressive pace than the volume. Units were rising as volume was falling. I think that's reflective of the REO market that was so prominent in the Santa Rosa marketplace in that 101 corridor. Okay, and now you see as units start to fall off again in 2012 that the appreciation is still happening. So we're getting lift on the average sales price, and units are starting to taper, which I think is reflective of Dean and John's comments about the go-forward look on real estate. One of the hot markets in Sonoma County is north. It's in Healdsburg, obviously. It's a beautiful town. It's a very quaint town. It's come alive in the last 7 years. The average sales price at $1 million and the median sales price at $685. Very different than the dynamics of the entire county. If we transition to Sonoma Valley, okay, which is the Sonoma, Glen Ellen, Kenwood area, the dynamics are very, very similar, okay? Very similar as the county, but the average prices are significantly higher. You'll see that the recovery began in 2007. Units and volume kind of tracked on the same curve. Okay, and what that means is that the recovery started without the big collapse of the REOs that we might have seen in the county as a whole. Okay, but again, 2012, 2013, units start to taper. Okay, and we see some lift. That's where we're getting the 8% trailing multiple years in a row of price appreciation. Dean and John tell us going forward, we're going to see 1% to 4% on that. If you take a quick snapshot of the Sonoma Valley, we got a couple of dynamics going on. In 2013, the highest priced home sold for $13 million. This past year in 2014, it's about 4.6. Okay, the highest price per square foot in Sonoma Valley, $1,800 a square foot. That's rivaling some neighborhoods in San Francisco. And the hottest neighborhoods up there are Lovell Valley, Kenwood Estates, and the east side of Sonoma. So that's a perspective for you just on the town, the immediate community surrounding the town of Sonoma. Okay, let's take it to Marin.
I love that picture, by the way. Marin County, very affluent. There, right there, that's Marin County. Am I wrong? That is Marin County in a nutshell. Very affluent. Doesn't it? You're right. That's not a bad point, actually. Most residents work in San Francisco. Again, they're commuting down the 101 into San Francisco. We'll see how the SMART train affects these folks as well. It's very. I mean, I can't stress enough. Marin is so brutal. if you want to build a new home in Marin, you're going to get sued, and you're going to have somebody who calls you the devil, even if it's a hillside surrounded by homes. Trust me, it's not going to be pretty. So, so consequently, it's part of the appeal of Marin, the tremendous quality of life of Marin, but it's also this very limited supply that makes for it extremely high, $900,000 plus for a median home price. Very expensive to live there. Prices are up again. We expect, again, more that muted, dampened kind of price appreciation going forward, but what it means is that there's kind of a hole in the demographics of Marin. If you're a young renter, you can probably want to live okay with living in somewhat substandard housing. There's places for you in Marin, or a granny flat, or if you're very affluent and look like those and have the income of those guys, and that's not a Starbucks, that's a Pete's, then you're priced out of Marin, and so you're not these young families. It's tough to get a place in Marin.
So great incomes, limited supply, but 1% growth in appreciation countywide.
Yeah.
And Marin County is a little bit like Napa County. We've got a northern and southern county, and the dynamics will be very, very different. The dynamics of this housing curve are a little bit different than the Sonoma and Napa County curves, in that Marin County was really more affected not by the subprime 2006-2007 meltdown, but the equities meltdown in 2008 and 2009. So you see the curve of units sold is decreasing in 7 and 8, and then slowly begins building up out of the bottom of the market, which seemed to be in 2009. On these curves, again, the average price, meaning the volume, and the units are tracking pretty much along the same curve. Okay, that means that the market lifted as the demand came back, but the demand is tapered, meaning the units sold is off. It's flat now, and the average sales price is about the same. It's very similar, as I just mentioned to Dean. There's two parts to the county, and one part of the county is white lightning hot. Okay, the average trade in Marin County is about $977,000. Excuse me, the median is about $977,000, and the average 1.3. But you got the city of Mill Valley that trades at about 30% higher than that at 1.3 million, and then you've got 5 cities in Belvedere, Tiburon, Ross, and Kentfield. I can count, that's 4. And they're trading at over $2 million, so 100% higher than the average. So again, the tale of two counties, but not more than one point in appreciation going forward.
There's been so much pop already, and it's so divorced from incomes already that how much higher can they go?
Okay, all right. Let's move on to San Francisco.
San Francisco, the new tech center, the new surging to everybody. Well, I guess shouldn't say Zynga. I should say Twitter, because Zynga is more or less out of business. But otherwise, you see a lot of software. I'm just being honest. You see a lot of software. You see a lot of the techie kind of person is gravitating towards San Francisco, not just the Silicon Valley anymore. So it's even improved. They've always had finance and those kinds of white-collar jobs, but now San Francisco has just a tremendous job market. Income's very high, strong incomes, growing incomes, one of the most expensive places to live in the world, but some major wealth disparities. You do have the proverbial millionaire walking over the homeless guy on the way into Rite Aid, because every Rite Aid in San Francisco has at least one homeless person in front of it. Fact. That's all there is to it. So you have some very high prices there. We see solid appreciation there, but again, slowing down going forward in the next couple of years. Now, in terms of supply here in San Francisco, it's a little different. On paper, there's a tremendous amount of supply. There's thousands and thousands of units in some very large communities like Hunters Point or Treasure Island or the Park Merced. But a lot of that is on paper, and it's still years and years away. So the reality of the supply is it's still fairly constrained in San Francisco. So a lot of folks are forced in San Francisco. Again, it's a net exporter of demand. Folks working in San Francisco are living throughout the rest of the Bay Area or even Sacramento or the Central Valley.
So I think there's 30,000 housing units on the books to be built in the city of San Francisco. I think 20 of those come from Hunters Point and Treasure Island. Those are probably 5 years away. The other 10,000, are they ever going to get through the city planning department?
We'll see. Hunters is already starting, but Treasure Island could be a long time away. Park Merced could be a long time away, and the rest are high rise here, a mid rise there.
Right.
We'll see.
Yeah, that's something the Chinese would love to be doing. They want to shift markets. Okay, this is one of the markets where we're going to give you a perspective on both single-family homes and condos, and they're a little bit different. Okay, very modest change in the last 7 years in San Francisco housing from units and volume. The curves track together. But once again, 2013, 2014, units are coming off, okay? Prices are firm, they're up, as Dean just shared with us, but units are off. Now, are we concerned about that? We're concerned about that a little bit because there's neighborhoods in San Francisco where we get 17 and 25 offers. So it's hard to track those different dynamics back and forth. This is the condo curve, very, very different. Condos, I think, it got caught in an oversupply situation. Towers got built that had to be converted into condominiums and things like that. So the curves are very different in terms of the falling units from 2007, 2008, sort of bottomed out either 9 or 10, I'm not really sure where, but then they track consistently growing through 2010 to 2014, where it seems like the volume and the units are in the same curve, which means the appreciation is coming with demand for units. Some highlights of the San Francisco market. The highest sale this year for a home has been $13 million in Pacific Heights. The highest sale for a co-op, call it a condo for translation purposes, was $16 million as well I think it was on Washington Street. The most expensive neighborhood, Presidio Heights, where the average transaction is $6 million. That's a tough neighborhood to get into as a first-time home buyer. I don't know, especially if you work at Zynga.
Zuckerberg.
You might have a tough time qualifying for that loan.
They're going to
Most transactions are in South Beach. I think about 356 transactions. I think that's reflective of just shy of 10% of all the units sold for single-family homes in the San Francisco market. And the rising star in Noe Valley, I think that's where Mr. Zuckerberg recently bought his house, and he's been working on it, Patrick, for what now? 2 years, something like that. He's making lots of friends. Anyway, Noe Valley is the rising star there. Okay, let's move on to Alameda County.
All right, let's go through Alameda. It's kind of relatively affordable. There's where some more families can live there. A lot of commuter buyers. It's still a major jobs node there, though. I want to make that clear. Strong incomes, though, surprisingly, $73,000, your median household income there. We see some solid appreciation. Again, solid appreciation in the past. Pretty good appreciation this coming up year. Going to slow down after that, though. And urbanization, I want to make a quick point about that. You're going to see more lock and go, more mid-rises, more high-rises in places like Brooklyn Basin and even down in Fremont. You're going to see a lot more urban product there in Alameda County. Contra Costa County, too, a little bit. But if you're the kind of low-maintenance buyer, you're going to see some more opportunities here.
So 9% year over year and 5% looking forward, whereas other markets are 8% year over year and 1 to 2% looking forward.
Yeah, well, 15 for most part, 15 is a little better across the board, but 16 and 17 is where we really start to see some more muted appreciation.
Alameda is the third largest housing market in units in the Bay Area, and job growth is pretty strong.
Yeah, job growth has been good.
It's pretty strong. Its affordability by its standards is not as out of whack as some of the other markets, and so that's why we're a little more optimistic on price appreciation there than something where incomes have grown 10% in the last 5 years, but home prices are up 40%.
So affordability is a driver.
Big driver.
Big time.
And just look at the number of people who can afford to buy there versus in Marin is a different story.
Yeah, got it. Okay. Alameda County, again, units. Recovery started in 2009, very, very steady, okay? Very, very steady. In our operation at Pacific Union, it's one of the most consistent, steady markets we have. There has not been high volatility in pricing. There are plenty of situations where there's dozen and 18 and 20 offers on homes in special neighborhoods, but it's a very consistent performing. You can see that the lines track very, very close together, so the appreciation is coming with the units of demand. But once again, 2012 was the high point for units. Okay, so the high point for units in most of these markets we're looking at is either 2012 or 2013, and we're seeing units taper off everywhere we go. A couple of highlights in Alameda County. The average price per square foot in Alameda County is $512, but you drill into some of the nicer neighborhoods, some of the more desirable neighborhoods like Piedmont, that's trading at $646 a square foot. And I think there are 5 homes that traded in Piedmont so far this year off the MLS, but we see them in the tax records over $3 million. The high one was listed, I think, for $8.2 million. The Rockridge neighborhood in Oakland also, trades at $641 a square foot, considerably higher than the average for Alameda County, and the highest sale there at $3 million, just like in the Berkeley Claremont district, sort of the same thing, almost $700 a square foot, and the highest trade at $3.8 million. So some of the wealthier jobs are living in those 3 different neighborhoods. Contra Costa County.
Contra Costa County, even more so than Alameda. It's more that commuter-oriented. Folks are living in maybe along the Highway 4, or even in La Miranda. You're tend to have people who are going to work in San Francisco or somewhere in the peninsula perhaps, or locally too. It's a more suburban environment, a little more affordable relative, but still have some very good incomes there. $81,000 is the median household income. A lot, obviously, the closer in parts in Danville and San Ramon influence that, but it still is a pretty decent income and jobs profile there in Contra Costa County as well. You have the new BART coming on Highway 4 in kind of a similar fashion that they have the SMART train. Will it open up some opportunities there? It could open up some opportunities in Contra Costa as well.
And so Contra Costa County had a lot of land, built a lot of homes, okay, so went in early. We're coming out of that, we're way out of that. A lot of home building going on out there or not much?
Modest. A fair amount in Highway 4, not much anywhere else though in the county.
And Highway 4 is at the lower end of the curve?
Definitely.
Yeah.
In price, yeah, for the Bay.
Okay, so as you can see that unit line, the housing in Contra Costa County, again, was affected by development, which a lot of that subprime debt was in, and it hit bottom in 2008 and has had just a fantastic steady recovery in both units and average sales price. But again, 2013, we're beginning to feel like a broken record here. Units are beginning to compromise in the marketplace. Some real hot points in Contra Costa County. One of the most desirable places to live is the La Miranda area. That's the combination of Lafayette, Orinda, and Moraga, where you have a median price of $1.2 million. You've got an average sales price of $1.3 million and an average sales price of $500 a foot. Okay, very different than the county as a whole. So as we give you these macro overviews, you got to know that every neighborhood and even every street is going to affect different dynamics than the county across the board.
The peninsula, San Mateo County, part Silicon Valley at its southern edge, part kind of the suburban extension of San Francisco at its northern edge. It's also extremely affluent, low unemployment, good job center, jobs kind of all throughout the entire peninsula there. We see strong job growth, decent income and job growth. Job growth, we haven't said that enough here. We do also project job growth to kind of simmer down here in 16 and 17 as well, in time with appreciation. But still, right now in San Mateo, if you go to Bay Meadows, a new tuck-under townhome is going to cost you about $1 million. So it's not like it's still the high rent district here. Price growth is projected to be slower. Difficult development environment. I guess we could have put that bullet on every single of these 9 submarkets and been truthful. It's very true here. You have a place like the Salt Works in Redwood City where they would build a beautiful master plan with brand new homes, and they've just had tenacious anti-growth sentiment there that they're still battling, and it's nowhere near happening, at least for sure not the near future. It took Bay Meadows, 20 years to finally get through. That's a redevelopment of a former racetrack that's in the market just now. So it's a tough place to build there as well. So again, you have many folks here who are working in San Mateo County are living elsewhere now because they don't have a choice.
And a great job market, 4.5% unemployment. Yeah. Arguably, 4 of the 4.5% are unemployable.
Probably.
So it's almost full employment.
They're in front of a Rite Aid as we speak, I believe.
And they're great jobs, okay? Yeah. So one of the things you're going to see that's different in this curve is we didn't see the volatility in San Mateo County, okay? That technology sector, those jobs that I think are created down there, we see it in our Menlo Park operation often. We don't see the volatility in the market, and we see a lot of wealth in the market. So you see here the volatility in 2007 to 2009, just not there. They had a very steady market where the rest of the markets in the Bay Area went through a lot of stress. Again, 2011, 2012, 2013, units begin to come off modestly. The hot pockets down there, a couple of them that are just phenomenal. You're going to get a place like Atherton where you've got a median sales price of $4 million and average price per square foot of $1,250. Burlingame at $1,065,000 with an average price per square foot approaching $900. So there's pockets in all these markets that are very, very different and perform differently. Even in declining units, we could be getting great appreciation on streets and neighborhoods and things like that.
Silicon Valley, Santa Clara County, Silicon Valley, you have Apple there coming in with 12,000 new jobs, and they're not going to close down any of the jobs they have in the original, that's the new Ring campus they're building. So job growth has been 70,000 over the last 2 years. There is some question about whether there's some potential for tech to start slowing down the job growth. It's probably going to happen, but it still looks pretty good for the next couple of years. We'll see what happens beyond that. It's one of the most affluent areas in the world, anywhere for a large population concentration, very affluent. Incomes are going to rise. We expect them to be about $105,000 in the median household income by 2018. New homes right now, if you want the new home right now, you're looking at attached. Townhomes have come to dominate the product of new homes in Santa Clara County. If you're looking at a new detached home with even a modest lot size, $1.5 million, $1.8 million, $2 million. So it's a very high price market. It's also, I think I have, but prices up. We expect prices there to slow also, price appreciation in 16 and 17. But I'm going to ignore that and say it's also another market where you have a fair amount of supply on paper. In the for sale market, you don't have a lot of supply coming onto the market in any given year. You have some rental supply coming on right now, but it's still a fairly undersupplied for sale market.
And great job market.
Fantastic
Highest
job
average job in the Bay Area, average paying?
Yeah.
Yeah. Okay, the curves here, very similar to San Mateo County, no volatility. The lines track pretty much consistently, units and volume, and we begin to see the same thing all over again. The markets have slowed in terms of units that we sell in every single one of the counties that we've shared with you. Some of the highlights here are Los Altos and Palo Alto. The average price per home in these marketplaces significantly different than the county. The average sale in Palo Alto area is 2.8, and I think that's for about a 4,000 square foot lot, and the average sale price is about the average price per square foot is about $1.3 million. So some of the dynamics that you've seen in Marin County, in San Francisco, San Mateo, and Santa Clara County, our western counties are very, very similar. Okay, we'll wrap it up here with a Tahoe market.
Real quick, resort getaway for the affluent Bay Area residents. We think of Tahoe and Truckee as very, very much impacted by the Bay Area, by incomes and by jobs in the Bay Area, which have been strong and are still strong. So that's a good sign for Tahoe. But in terms of, but the same thing, as we see jobs and appreciation start to slow in the Bay Area, that has potential to have impact on Tahoe and Truckee as well. I'll let you handle the pricing stuff.
Okay, so very volatile market here. You know, huge average sales prices in 07 and 08, and very absolutely minimal trades happening. And really only in 2011 did the units start tracking with the volume. Once again, it's fallen off. And these are the single-family homes. Same thing with condos, although a little bit more volatility. This market tracks with consumer confidence, jobs, things like that in the Bay Area, because it's very much of a second home market. So going forward, I think we're going to probably see softer units and abbreviated appreciation?
To the extent that we're right, it's impacted by those Bay Area fundamentals, then that makes sense.
Okay. One real amazing dynamic in the Tahoe markets, there's 4 golf courses in the Truckee area there, or maybe there's 5. Martis Camp, Gray's Crossing, Old Greenwood, Schaefer's Mill, and Lahawton. The average, or the median sales price in there is $3 million, okay? There's a lot of Silicon Valley money up there. The jets on the runway up there are pretty amazing at, average prices of $700 a square foot compared to Tahoe Donner at $622 and $310 a square foot. I think at this point we're going to transition back to John, and he's going to walk us through some similarities in employment and most importantly, the Burns Home Value Index looking forward. John?
Yeah, okay. Remind me when we get to Q&A to talk about demographics too, because as we were going through this, I think we left something important out.
Okay.
In terms of home sales volume, what we're seeing already occurring is the number of investors are declining in numbers, and the number of real buyers are starting to run flattish after growing. So I think you see a big disconnect here, right? Median incomes, even in the best case of $110,000, well, that means you can afford a maybe $500,000 house. Median home price is north of $1 million. So we're really catering to just this really affluent slice of person, and I'll hit the demographics now, the number of the people born in the 1940s, 1950s, and early 1960s have done really well in this recovery and have done really well throughout their lives, and I think are going to drive Tahoe and Truckee, but have been driving a lot of this. As we transition towards selling homes to people born in the 70s, 80s, and 90s, they just don't have this kind of dough. So here's what we see going on is we think there's some legs left in the San Jose market, and we're going to see more volume there. But the rest of the markets we think are going to be pretty flattish looking forward from a volume standpoint. A lot of lines on this chart, but they're all trending pretty much the same. San Francisco is the big one in the yellow there. Right below it would be San Jose in the East Bay, and all the way down at the bottom, Napa. The dotted lines are our forecast. Now, you have to have a mortgage rate view and a job growth view, as Dean talked about. So we think the economy is going to slow down a little bit, but continue to grow. The bond market is betting that interest rates are going to go up, so I'm betting that interest rates are going to go up. The bond market's been wrong the last couple of years, so that should start to put a lid on pricing. So our view here is we're not that far from the top unless we get a whole bunch of people from China coming here and driving prices up, because all this income stuff doesn't matter to them, because we did a 57-page paper on the foreign buyer last year because I didn't understand it, and now I think I understand it, but I can't project it. But it's all about, if I could generalize, safety of investment here in the United States for one reason or another. And maybe we can talk about that in the Q&A. But that would be another, I would call it, you asked me for risk to the outlook. That's the upside to the outlook, that they keep coming here. So with that, I think we're ready for some Q&A, right?
So we'd love to take any questions. We have 2 microphones at either side of the stage floor here. Please feel free to step up and ask John or Dean or I a question. John, I'll start with one. Incomes seem to be rising at a decent pace. Population is rising, and yet units are off and pricing is going to get soft. What's the disconnect?
It's too expensive.
It's too expensive.
Yeah, so incomes on average are growing 3 to 4%. You've got the tech sector guys that are doing a lot better than that. But at some point, not Zynga, but the other ones wake up and go, why am I paying my back office staff $80,000 and they're complaining that and they need a 10% raise because they got to find a place to live. I'm going to have to move them to Sacramento or move them to Austin. And actually Texas has been recruiting here a lot, and we're seeing a lot of it going to Texas. So at the end of the day, I think we're going to see population growth slow because that person's going to say, I just can't afford to live here.
Got it. Steve, question.
Yeah, my name is Steve Schnardeman, and it's delightful to have access to John Burns, like eating cake. So we just have a new Congress starting with a lot more budget hawks. So my question is, what's the likelihood of the repeal or reduction in the mortgage interest rate deduction, and what would happen if it was repealed or eliminated?
The likelihood of a mortgage interest rate deduction is non-existent because all Congress people use it. But I will give you the warning thing. If they look at it really from a budget standpoint, we did a white paper on this too. It only saves the government about $5 billion a year, which is nothing to them. And it all comes out of 5 states and really about 10 metro markets, and this is this one. And if you get out of this market, people aren't buying homes for the tax savings anymore. I know when a lot of you talked about that, what has happened now is that the standard deduction for a couple is $12,000. The median home price in the country is now $200,000. Hey, they're paying $8,000 in interest. The mortgage interest doesn't even get them out of the standard into the itemized deduction. So it doesn't help the federal deficit. It doesn't help Congress people. I think the chances is about close to zero as you can get.
Thanks. Jim.
Dean and John, you'd mentioned that the venture capital money is still pouring into San Francisco and the Silicon Valley. What do you see as a difference in the companies that they're investing in compared to 2000, 2002?
There we might slightly disagree, because one of the arguments is that what's different now is that there's revenue. There's certainly revenue behind Google and Yahoo, sort of, behind some of the tech. But as John would point out, there's not revenue behind a lot of those other venture capital impacted software and tech companies as well. I mean, am I being fair?
No, you're being fair. I think that it's less frothy than last time around, but that doesn't mean it's not frothy.
Yeah.
But
it's huge, too.
It's pretty clear, though, that the venture capital funding is going into companies that are making money and have revenue. That's your point,
Not always.
Not always?
Not always.
No?
Twitter. They're just now starting to do revenue. Instagram has no revenue. So there's still a lot of venture capital and things that have yet to realize revenue. What I think is different is that Google and some of these others have shown an avenue to revenue that wasn't obvious in 1999 and 2000.
Yeah. Steve, you got another question?
Yeah, I was just on the Chinese side, because a lot of the data you showed was a slowing appreciation on some of the home prices. So is that going to have any impact on the Chinese investment over here now?
No, that's a perfect segue. Can you come up? Can I really? I'm not kidding.
Yeah.
I'm going to get him to answer these questions. So a lot of this has been driven by foreign money. And we can argue that the signs of a market topping is maybe the introduction is done in Chinese. So I mean, that's kind of a unique thing going on right now. What has driven China over the last 15 years? And is there anything changing that can cause it to slow down? And I could have a lot of follow-on questions, but I would love to hear your thoughts.
Well, I mean, just a very simple understanding of the Chinese economy. It's first, you've got an enormous amount of wealth that's been created. And it's possible to take the money outside. It's not as hard as it used to be. So I think on the one side, you've got this big economic, there is more wealth around the place. I think the other side is that, China's becoming, is quite polluted. And there's a lot of sort of food safety issues. And the 64% of the Chinese millionaire class are now looking to move overseas and maybe get a green card or even get a citizenship. And that's an incredibly high percentage. And so that you've got that dynamic. Then you've got the fact that there is an unbelievable dynamic of 80% of the Chinese millionaire class are looking to send their children to study overseas. And where are they going to choose? Number one is California in the world. And so that dynamic as well is playing. So you're sending your children earlier and earlier, age 16 now, for some of the sort of super rich, if you like, which means if they're here from 16, they're probably going to do 8 years of schooling here, which is going to promote again, buying a residence. And then one final comment I'd say is that, again, we looked at where the Chinese are looking to buy residences or real estate overseas. And number one in the world was this part of the world. Mm-hmm. So it is the Bay Area, it is LA, it is West Coast America. That is number one. And then, in fact, of the top 10 destinations that Chinese want to buy in, it's America, number 1, 2, I think Canada is in there as well. But basically, it's America, it's USA, and it's West Coast here. So you've got amazing dynamics here. You've got on the one side this schooling, amazing schools, and everybody wants to come here. Plus, you've got money in China anyway.
And are they trying to reverse it to make it harder to get the money out? Because how you get your money out is through Hong Kong, which they're trying to crack down on that, or you come 50 grand at a time with 20 of your relatives, which is wondering how they've been buying here.
If you're going to see the prices in China going up, and you're living in a very small, living in Beijing or Shanghai, the value for money that you can get here, the bang for your buck, is enormous. So I think that is, if prices continue to drive up in China, you're going to see more people buying here. And at the same time, this 2014 is a real cutoff point, because it's the first year, in my opinion, that you can really say the Chinese entrepreneur is going international. Because before that, and I know you've been a bit spoiled for choice here in the Bay Area and LA as well, and you've had people coming early, the last 5 years. But generally speaking, if you're going to put a stake in the ground, 2014 is the first year of the Chinese entrepreneur going international.
Steve, you got a question?
I do have a comment and a question. The comment is that we represent the CEO of Zynga and a lot of the top management.
I love Farmville.
Don't sell them short.
I just, my kids like Farmville.
The question is about quantitative easing and the $80 to $100 billion a month that was being pumped into the economy from the fourth quarter of 2008 to now that is going away. Can you tell us what you think the end result of that going away is going to be? And really, what's going to happen when all that money that's been sloshing around actually enters the economy?
So the question is whether or not it's actually going to enter the economy. So a lot of we've got a large investor clientele that are more hedge funds and those types who tell me the Fed, when they stop buying, is going to keep reinvesting so they stay at about the same size. It should mean interest rates, particularly mortgage rates, go up a little bit, because mortgage rates are going to trade, I believe, at a bigger spread over the 10-year Treasury than historically, because there's more risk associated with a mortgage now than there was to be a mortgage investor. The thing that gets, and I've read a lot of really good research about why interest rates may stay low for a very long time, and the one that makes me extremely convinced is that the US government now has $16 trillion in debt, all of which refinances on a short-term basis. So if interest rates go up 100 basis points, 1%, that's $160 billion a year that the government, in additional interest, the government now has to pay on its own debt. So if the Fed raises interest rates 1%, they just threw the federal deficit under the bus for $160 billion.
$1 billion.
So they're really boxed in. So, and I got to hand it to the Fed, though. I think they understand all this, and they know what they're doing, and they're not. I have not heard any credible argument that they're going to start raising interest rates quickly for any credible reason. So maybe I copped out on that, but that's my view of it.
Any other questions? Craig, you got a question?
Yeah, quick question. In many of the markets that we've reviewed, the 9 different markets, we see sales units decreasing in 2013 and year-to-date 14. Do we think, or I'd be curious to hear your opinion on the impact of the off-market, not in MLS sales?
So we were discussing that earlier, and definitely the numbers are low because of the off-market, and Mark knows that better than anybody. But I'll tell you that that's a trend that's going on across the country, and we buy closing data, so we actually go to the county records and get it, and sales are down using closing data too. So even though the MLS data may be misleading for that very reason, the declining transactions is true.
Yeah, it's something John and I talked about, earlier today, and it's a dynamic we deal with obviously every single day in all of our markets.
Yeah.
Last question. There was one over here.
I have a question. The common thread is how units are dropping off in all 9 counties. You also mentioned that it was due to slow population growth as well as people not being able to afford homes. But would you also attribute that to the fact that a lot of people are buying and holding because rents are so high? And is there any data on that? As well as there's been such a high growth percentage, 40% in some cases. And so does that equate to people saying, I don't want to pay capital gains, I'm going to buy and hold? Is there any?
Because they're holding it and renting it out, cash flow positive.
To affect the decline in units?
I believe that strongly. And I'll even take it a big step further. So the Blackstones and Colonies and Starwoods have been buying like crazy are all clients of mine. And there are something like 13 or 14 million units that are single-family homes that are rented out across the country. And there was 11 million going into this. And think about that young family that lives in the Bay Area that makes $80,000, that wants their kid in a good school district, that's paying a lot of rent, and is never going to end up with a down payment. They're your house renter profile, and it used to be I could go rent it from somebody I've never heard of who might decide to sell the house and throw me out. Now I can go rent from a publicly traded REIT who I know is not going to sell the house, and it's a very legitimate alternative, and my payment is $2,000 a month. And yes, they may raise the rent on me next year, but I just can't get into home ownership. I think it's I'm showing it from their standpoint, because I do think rents are going to continue to grow, and the people that are holding on to those opportunities are going to, they're going to cash flow.
Yeah.
And real estate's a pretty safe bet.
Yeah. And rents are going to go up anyway. So if you're at the life stage where you need to be in a house as opposed to an apartment, then it's a perfect option.
Amy, do you have a question?
Yes. In the Silicon Valley, we continue to see a strong command coming from overseas buyers like China. And these are the buyers who have no income constraint, and they will buy anything that is available on the market. And you were saying that you are seeing the growth, tapering or coming down. How do you think that how would that impact the price, or would that spur the growth sentiment? And the second one, I actually have a question about the mortgage. I have read the formal management from PIMCO. They are really invested to peer-to-peer mortgage. Do you have any comment about that might impact our industry?
So really being, at the end of the day, the lender themselves. Yeah, so that's why I asked Rupert to come up, is I can't predict how many more people from China are going to keep coming here. I can't. I keep trying and looking and reading, and it all sounds good. But I think, if prices go up another 10 to 20%, it's because I was wrong there. It's because we continue to see them continuing to grow. Going back to what you said about PIMCO, these are your bond funds that are 4% is high yield for them right now. So a mortgage at 5 is super high yield, and they want to buy mortgages. The issue in Dodd-Frank, though, actually makes PIMCO and BlackRock, the guy who bought the mortgage, now liable if there was an underwriting mistake. They ain't going to touch that with a 10-foot pole. So what some of them have now done, and Impact just announced this, I think, last week, is they're taking direct investments from groups like that into lenders who are willing to say, you know, that safe loan that doesn't fit in the credit box, which the best examples of that are retirees. Oh, I've got loads of examples of people who are trying to get 25% LTVs and can't because they're retired. Those are the loans that are now I'm starting to see being made, funded. I don't know if it's PIMCO that's doing that, but funded by those type of funds who really want to get some 4 and 5% yield into their portfolio.
Would that provide the relief that you just said?
It will, but there, again, in fact, Scott Simon, who ran PIMCO for a really long time and just retired, told me this. He said, people need to remember that a guy running a bond fund, his mandate is not to put the principal at risk at all. He will take interest rate risk, but he doesn't want to, he should not be buying anything where the loan to value can go upside down and he can get into, and that happened to them this time around. So until those rules get clarified, those guys are not coming back in a big way.
Okay, we got to move it along, but John, I want to ask you and Dean one more question. Hot housing market here in the Bay Area, how does it compare to the United States?
So we rank all the markets in the country, and this is numero uno. I mean, this is the strongest housing market in the country by far, honestly.
Yeah, we work in some pretty good zip codes.
Yep.
So, okay, we're going to wrap it up here. Before I do that, reception is up and down. Okay, so we're going to have a nice reception. Thank you all for coming. I got a couple of comments here, but the reception is going to be either upstairs or downstairs. So John and Dean have put their necks way out there. They go out on a limb and they're predicting 2017. I'd say it's a very conservative outlook. We, as real estate professionals and our clients, are constantly trying to predict the market, right? And our clients are trying to time the market. Well, I want to share a couple things with you. The picture on the top here is Nikki Beach and St. Bart's in the Caribbean. Okay, it's a fantastic place. And if you have the ability to predict the market, this is where you can live and retire, okay? The picture at the bottom happens to be the airport in the same location, okay? The beach at the end of the runway is Nikki Beach. It's a really, really short runway, okay? So timing is really important here, okay? And if your clients are going out there to try and predict the market and outsmart the market, instead of like Leslie Appleton Young said 5 years ago, it's a short runway. I want to thank John and Dean and Rupert and all of you, our guests that speak Mandarin, our guests that are streaming over the video. It's been a fantastic afternoon. Thank you for coming. We look absolutely forward to being here next year to talk about Real Estate Outlook 2018. Thanks for coming.